Hello students, welcome. I am Vipul Mittal and in this session I will discuss the meaning of the term pervasive. So there could be misstatements or there could be undetected misstatements. And these misstatements or undetected misstatements could have pervasive effect on the financial statements. And if these misstatements have pervasive effect, then you will accordingly express an opinion. But first thing is that you need to know whether those misstatements or undetected misstatements have pervasive effect or not. What this term pervasive means. So this is a term that describes the effect on the financial statement, effect of misstatement on the financial statement. What is the impact of misstatement on the financial statements? Or what is the possible impact of undetected misstatements on the financial statements? So you identify misstatements, or some of the misstatements are still undetected. You have to make a judgment. You have to make a judgment whether these detected misstatements or undetected misstatements have pervasive effect or not. Now, when do you say that misstatements have pervasive effect or undetected misstatements have pervasive effect? Under three circumstances. When the effect of misstatements or possible effect of undetected misstatements is not confined to any specific element, account, or item, then you say it has a pervasive effect. So material misstatements have pervasive effects. That is, these effects are not confined to any specific element, account, or item of the financial statements. These effects are not confined to any specific item, element, account of the financial statements. For example, account receivable have errors. Inventory, which should have been reported at lower of cost or net realizable value, is reported at lower of cost or market, which is incorrect. Impairment testing on property, plant, and equipment not done, which was required under GAAP. Multiple errors. Research and development expenditure are capitalized, which should not have been capitalized. When there is no business combination, goodwill should not be recorded, but goodwill is recorded. Multiple errors. Effects of misstatements are not confined to any specific element, account, or item, but are pervasive. So the effects are not confined to any one element or account, but multiple accounts, elements, items have errors. Now, what if the effects of misstatements are confined? So it is possible that effects are confined. So if it is confined to any specific element, account, or item of the financial statements, then also you can say it is a pervasive effect if it represents a substantial portion of the financial statements. So we are discussing effects of misstatements, and effect is confined to a single element, account, or item. But that item represents a substantial portion of the financial statements. For example, inventory is not properly stated, inventory is misstated. Inventory reported by management is $900,000, which is incorrect, and value of inventory reported should be $400,000 only. This is the correct amount. There is an error. There is a misstatement, and this misstatement is confined to a single item. Now, the question is that whether this misstatement has a pervasive effect. Answer is this is confined to a single item. Then does it represent a substantial portion of the financial statements? Say that, okay, yes, this inventory accounts for 70% of total assets. You say that yes, because inventory account for 70% of total assets, then it represents a substantial portion of the financial statements. Even if misstatement is confined to only inventory, still it has pervasive effect. Or investments are not properly reported. Investments are reported at fair value, which is incorrect when they should have been reported using the equity method. There is a misstatement. Again, whether it has pervasive effect. If it represents substantial portion of the financial statements, yes, investments account for 80% of net assets. This investment accounts for 80% of net assets. It represents a substantial portion of the financial statements. Even if the material misstatement is confined to just investments, it has pervasive effect. All right. Third situation. If pertains to disclosure, then it is fundamental to users' understanding. If misstatements pertain to disclosures, then they should be fundamental to users' understanding of the financial statements. Is it fundamental to users' understanding? Then it has pervasive effect. Generally, you have this when most of the disclosures are missing or most of the disclosures are misstated, that they have pervasive effect. So here we are talking about three situations when effects of misstatements on the financial statements are pervasive. So effects are pervasive when these effects are not confined to any specific element, account, or item. If the effects are confined, effects represent substantial portion of the financial statements. And if they relate to disclosures, then these are fundamental to users' understanding of the financial statements. All right, students, do watch videos on misstatement, material misstatement, and auditor's opinion to get a complete understanding. We'll connect again.